Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to save a little bit of money out here. My job is not just entertain, but to put it in context. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. When I was running TheStreet.com, the online news journal I started in 1995, I found out how hard business could be. Hardly a quarter went by where we could meet our quota for ad revenue, which is why we set up a more stable subscription business to cushion the shortfalls. But then one day I got this call from one of the most infamous companies of the dot-com era. It was a bit of a summons. When I sat down with this guy who was rich as Croesus, he said he wanted to do all sorts of things with me. An investment, ad buys, the works. Dot-com nirvana! I sensed pure greatness. Lucre. Just the imprimatur alone would be a home run. I could see the headlines. But then I heard the other side of the deal. In exchange for the investment, I'd take the money and buy a requisite amount of goods from his company. Basically, I was being asked to make his quarter. Seemed pretty circular and pretty fishy. But we both ended up looking great. I told him I wanted to speak to my lawyer first. And you know what? My lawyer shot it down immediately. He said you can't invest in a company that gets your money back in your own wares. That's what's called a lazy Susan deal. And these can be fraught from an investor and a legal point of view. My lawyer told me never to speak to that person again. Not long after this man's company got crushed as part of the dot-com collapse. Thank heavens I didn't deal with him. So in a day where we keep hearing that there's a bubble brewing in artificial intelligence world, I come back and tell you that the bubble's been bursting for weeks now. And we're now getting a lot of the signals that we saw back in the dreaded year 2000. Believe me, I was in the scrum then. It has a major impact today, with the Dow slipping 228 points, S&P tumbling 1.16%, the NASDAQ plunging 1.81%. All because of this stuff. These days, we're constantly hearing about what I call these lazy Susan deals, except they're being celebrated as good news for both parties. Today, for example, we learned that OpenAI is in talks to raise at least $10 billion from Amazon, some of which would be spent on Amazon's AI chips. We heard applause for this all day. Basically, Amazon's giving OpenAI at least $10 billion, even as OpenAI has a very stretched balance sheet with huge obligations that dramatically exceed its ability to bring in cash. In return, OpenAI will spend that money on Amazon's chips instead of maybe using NVIDIA's. Doesn't that raise some eyebrows? Wouldn't it be better, more natural, say, for OpenAI to just pay for the chips itself? Or are we breaking out the lazy Susan table again, like in 2000? Oh, I sure hope not. Amazon's a serious company. I don't know why it would pay OpenAI to use its own chips. I found the whole thing quizzical. Very similar to the deal that I turned down from that giant dot-com company at the end of the internet bubble. I know that Amazon Web Services and OpenAI had an existing partnership from early November where OpenAI committed $38 billion for a multi-year deal to run its workloads on AWS. Does Amazon's $10 billion payment to OpenAI help OpenAI pay for that agreement too? Now, it's entirely possible that people want to be involved with Sam Altman's OpenAI so badly that they're willing to invest in that company to get the money right back. But I'm growing ever more concerned that these kinds of deals, and as you shall see later on in the show, I'm starting to think that OpenAI is not that special with no moat around ChatGPT, and the deals are bad. It's getting a real run for its money now, ChatGPT. That means the most ballyhooed $500 billion valuation may be off the mark, and people shouldn't be valuing it that high. Certainly not the investors. I'm not saying that things are falling apart in this part of the financial world, but I am saying that as the bubble bursts, and it is bursting, we're going to see discipline at work because most companies have survival instincts. This morning, the Financial Times broke this terrific story that said Blue Owl Capital is refusing to back a $10 billion deal for a planned Oracle data center in Michigan. Not that long ago, I interviewed a Blue Owl executive who talked about the disciplined way it approaches investments. I believe the discipline is why Blue Owl refused to do the deal. I salute them. This story comes right as Wall Street Journal is questioning Oracle for relying on a squishy number, a $300 billion 5-year agreement with, again, OpenAI. Oracle didn't formally announce the contract, but it put it in what's known as the remaining performance obligation line, which for many means is basically a done deal. Some of us regard that as almost cash in the bank. Boy, do we look silly. Well, at the time of the announcement, the market assumed that the contract was worth its weight in gold. So Oracle stock jumped 36% in a single day back in September. They've been other contracts in the RPO, remaining performance obligation line, now stands at $523 billion. But Oracle stock has gotten crushed as we found out more about that OpenAI relationship and how fraught it is becoming. These days, investors are feeling pretty darn dubious about it, which is why Oracle stock got shelled again, falling more than 5% to 178 and change. That's down from $345 at its all-time high just a few months ago. The stock has now wiped out most of the value it gained when Oracle decided to become king of the data center builders. Will it give up the rest? Yes, if it doesn't stop the spending and gets disciplined. Oracle and OpenAI are killing the data center cohort for certain. So what does this mean for you? Remember last night I said that we have a Godfather situation going. There are 5 families: Meta, Amazon, Alphabet, Microsoft, and then the 5th, which is Oracle, OpenAI. 4 of these companies are spending fortunes, but it's of their own cash. And it's in part to stop OpenAI, which behaves like it has unlimited capital. But it doesn't. OpenAI's reckless spending can't be maintained without the help of others, which is why it keeps doing deals like the one we just learned about with Amazon. Some call these kinds of deals circular transactions. Others call them vendor financing. To me, it seems like a lazy Susan transaction of .com euro. And that's why I'm saying the bubble popped a while ago, and now it's deflating quickly. That's good. We want companies doing rational things, not delusional things. We want discipline, with Blue Owl pulling out from an Oracle data center after Blue Owl stock was clocked over balance sheet concerns. Discipline is coming. We aren't there yet. Press reports indicate that there are other sources of financing and Blue Owl's not needed. I wonder how much OpenAI is really worth if all the powers that be, including Oracle, exercise discipline, as the bond market seems to have lost its appetite for Oracle's debt, and surveys show that ChatGPT is barely ahead and in some cases falling behind what is starting to look like a very commoditized business. Let's not get caught in the weeds, though. The whole AI industry seems to be concerned that OpenAI may not be worth $500 billion, even though it has $1.4 trillion in spending commitments, which is why I think it keeps doing what looks to me like lazy Susan deals. Now, Oracle stock has collapsed because they're doing so much business with OpenAI, and that pain has spread to the entire AI data center complex. I think that's probably wrong. Discipline will reign in the out-of-control capital expenditure budgets from all the hyperscalers. They'll slow down, be more prudent, and not trash their own balance sheets. When discipline arrives, it'll be a huge win for the industry. You will then be able to buy NVIDIA and Broadcom again. It's just that the losses have to stop first. You need to see Oracle blink first. That's the Sonny Corleone toll booth situation writ large. Bulls have to hope that Micron's strong enough at the numbers tonight can help. I don't know. Until we know for sure, the bottom line is these stocks will keep getting hit. Sooner or later, I think we'll get a Godfather-style truce on spending, and then everyone can benefit. But it's simply not safe to bet on these stocks yet until someone says no to these kinds of circular deals and calls them for what they really are: lazy Susan deals that my lawyer told me don't you dare even think about doing, let alone actually taking the money and giving it back discreetly in goods and services to pump up the quarter and the valuation. Daniel in Massachusetts. Daniel.
Hi, Jim. Good evening. Thank you very much for taking my call. I appreciate it.
My pleasure. Thank you, Daniel. A little fired up here. What's going on?
First of all, I want to wish you and your family a Merry Christmas. You're a great guy.
Thank you. Thank you, buddy. I appreciate that. What's going on? Well, how can I help you?
Listen, I'm calling about the streaming giant Roku. What do you think about Roku?
I like it. Okay, it's got a lot of positive chatter about the numbers. It's just been going up, and up, and I think it makes sense because that's where the advertisers want to be. Presley in Florida. Presley.
Hey, Jim. I'm Presley, like Elvis, from Jacksonville, Florida. I have a quick question about Take-Two Interactive.
Sure.
With GTA 6 delayed to fall 2026 or later, what changes are, as you've taught us, baked into the price? And is a successful GTA release going to bolster the share price enough to be worth investing in now?
Absolutely. It's the greatest entertainment franchise of all time. I think you can buy some here and buy some a little lower. Strauss Zelnick will deliver for you. He will. Don in Florida. Don.
Booyah, Jim. How are you?
I am good, Don. How about you?
I'm great. Jim, I am a club member, and
Excellent.
I watch your show every night. I wouldn't miss it.
Thank you. Thank you very much.
Okay.
Let's go to work.
Here's my question. Robinhood. It's off, over 20% from its highs right now. Do you think, is it a buy, sell, or hold?
Okay, this stock just went up straight up. And now when they start coming down, when they've been straight up, they don't stop as fast as you'd like to see. That's why what we're going to do is let Robinhood come down below that last dip, which took it down to 103. Maybe you go to, say, 95, and then pull the trigger. If not, then just say you missed it. All right, until someone finally calls out the deals we're seeing with OpenAI as Lazy Susan deals, well, I just think it isn't safe to invest in many of these AI stocks. But it's going to happen. Discipline is coming. On Mad Money tonight, Medline came public today in the biggest IPO of the year, and with the stock soaring out of the gate, is the valuation too rich for you to get a piece of the deal? Then, the most straightforward way to find earnings per share growth is to turn to the buyback monsters. I'll reveal the names that made my list and how are consumers really feeling about the AI chatbots. Is there a moat around ChatGPT? I'm talking 100x to hear what the research is signaling, and it is always methodical and empirical, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Earlier today, we witnessed the largest IPO in over 4 years when Medline came public with a bang. This is the biggest provider of medical surgical products and supply chain solutions for the healthcare industry. It came public with a gigantic $6.26 billion offering, but it feels like a deal that really kind of snuck up on us because this isn't exactly a household name. Medline's revenue is split pretty evenly between selling its own Medline brand medical surgical products and handling supply chain solutions for the healthcare industry, but the vast bulk of their earnings comes from product sales. Still, the supply chain business lets them see what hospital needs and also helps them move their merchandise. When CEO Jim Boyle came on Squawk Box this morning, he described Medline as trying to be the Costco of healthcare. They have a membership model, the supply chain business that lets them give healthcare providers the best prices. Meanwhile, the Medline brand products, they're kind of like Costco's in-house Kirkland signature brand, carry much higher margins than the rest of the merchandise. It's premium private label. Now, let's talk over the numbers. Over the past few years, Medline's put up solid revenue growth, 8.3% in 2023, 9.8% in 2024, and 10.3% through the first 9 months of 2025. High single-digit growth that seems to be accelerating. I love ARG, which is accelerating revenue growth. Medline's also solidly profitable. Their Medline brand segment has seen its EBITDA margins rise from 20.4% in 2022 to 25.4% in the first 9 months of this year. Although that's down slightly from where they were in 2024, the supply chain business carries much lower margins, just a 5.5% EBITDA margin, but still turns a profit. How about the balance sheet? Okay, 4 years ago, a bunch of private equity firms took a majority stake in Medline. The deal gave the company cash to do an acquisition in 2021, also make a $2.3 billion investment in its own infrastructure. But private equity-backed IPOs tend to have a suboptimal balance sheet because their owners pack them to the gills with debt. Medline's balance sheet isn't terrible, and it certainly helps that they just raised more than $6 billion from the IPO, $4 billion of that going toward paying down debt. After that, management says a leverage ratio of roughly 3.25%, which, by the way, they plan to get down to 3 in short order. I can handle 3. It's pretty manageable, not ideal, but good enough. There's another private equity problem here, and it comes down to control, and this one's confusing. Simply put, the public shareholders won't have any. After this offering, the public, the people who bought Medline shares through the IPO today, will have a low teens percentage of the voting power, with existing pre-IPO shareholders controlling more than 80% of the voting power. The combination of 3 private equity firms, 2 sovereign wealth funds, and the founding Mills family, those are the ones who will control 2/3 of the vote. Is it an issue for you? Frankly, these days, it's pretty common to see companies coming public with different classes of stock or some other ownership structure that, in effect, makes it so the common shareholders like you and like me don't have any control. And if that's a deal breaker for you, you've missed out on many great stocks over the past couple of decades. However, if the regular shareholders can't have control, you know what? I actually prefer that to be because of the company's founder who created the business and has a vision for the future, maintains control. It doesn't bother me one bit that Mark Zuckerberg rules Meta platforms with an iron fist. Zuckerberg knows what he's doing, and his business is his baby. But this cadre of private equity firms who control Medline, sooner or later, they're going to want to ring the register. And that's why they did the IPO. They're starting the process of cashing out. And as they sell, it can put real pressure on the stock. Probably won't be an issue anytime soon, but longer term, there's a ceiling on this one until the private equity guys have fully liquidated their positions. So is Medline worth buying after today's IPO and the stock's subsequent rally? This was a very successful deal with the stock up more than 41% today. Initially, Medline was only looking to sell 179 million shares for $26 to $30. But demand was so high that they sold over 216 million shares at $29. Today, Medline opened for trading at $35, up over 20% from the offer price, and then it added a few more bucks after that. At the current price, Medline has a market capitalization of roughly $54 billion, making this a nice win for the PE firms. When they invested in Medline in 2021, the company is valued at just $34 billion. But I do think that the stock looks a little rich here, and I'm reluctant to recommend it after this strong opening. We know from the IPO prospectus that Medline earned 68 cents per share through the first 3 quarters of the year, and annualize that, and you get to 91 cents of earnings per share. Given the current share price, the stock's traded something like 45 times my back-of-the-envelope earnings estimates. That's a lot of a company with low double-digit revenue growth. I'm uncomfortable with that. Another way to approach Medline's valuation is with an enterprise multiple. Let's do that. That's the market cap plus the net debt divided by the EBITDA. Medline's enterprise value is about $70 billion, and it's annualizing its EBITDA from the first 9 months of 2025. We get $3.55 billion for the full year. That's meaning the enterprise multiple is something like 20. The tough thing here is that we don't have a lot of great comparisons for Medline, which is part medical supplies company, part distributor. The company's prime vendor model means that much of its revenue is recurring in nature. We like recurring revenue, even if it's not actually recurring revenue like, say, a software company would have. But whether you're talking about pure medical supplies and companies like Owens & Minor, or Solventum, or medical device companies like Becton Dickinson, or Baxter, or even drug distributors like Cardinal Health, yes, McKesson, Cencora, they're all cheaper than Medline. All of them, generally much cheaper. That's not good. Looking at the rest of the cohort, I'd be willing to give Medline an enterprise multiple of about 15. That translates to $29. That's exactly where the stock came public. Might be worth more than that, but I don't want to chase it after this huge first day move. That's been a sucker's play. So here's the bottom line. We had the largest IPO in over 4 years today, and it generally went pretty darn well. In fact, it went so well that Medline looks a little too expensive for me. Even though I like the company, and I really do, I wouldn't buy the stock up here. I'd say wait for a pullback, maybe down to 29 or 30 before you pull the trigger. And if that doesn't happen, you know what you have to do? You just got to say you missed it. Mad Money's back after the break.
Coming up, looking for a steady opportunity with the market in flux? Cramer's revealing his best buyback monsters to help you find potentially built-in earnings. Next.
With the data center trade flagging, we're seeing money rotate back into all sorts of non-tech growth stocks. And if you want earnings per share growth, the most straightforward way to get it is by betting on companies with enormous buybacks. Even if the underlying business isn't growing, as long as they're repurchasing enough shares, they shrink the share count and therefore their earnings per share soar. Buy. Since the end of 2015, there are 51 companies in the S&P 500 that have reduced their share count by more than 30%. That's amazing. Of course, not all of them are worth owning, though. A big buyback can't save you if your business is falling apart. Sometimes buying back your stock is not a good investment. In fact, the top 5 repurchasers over the past decade have all underperformed the S&P. That's why I went through that list of 51 companies to pick out 10 that are worth recommending to you. Now, first up is one of my old favorites, is Applied Materials. It's a semiconductor capital equipment maker, which has reduced its share count by 31% since the end of 2015. Now, this stock had a strong year. It's up over 50% for 2025 because we have insatiable demand for all sorts of semiconductors, especially, believe it or not, the commodity ones, which means there's equally big demand for the machines that make semiconductors. But Applied Materials, AMAT, is also a great long-term performer. It is up 1,200% since the end of 2015 versus 229% for the S&P 500. Now, some of that's the strength of the core business, and some of it's the voracious buyback. By the way, it is a terrific example of the kind of stock I suggest you buy in my new book, How to Make Money in Any Market. This is the essence of what I'm trying to get across to you. Second, don't forget that Apple, the second largest company in the world, also happens to be a buyback monster, having shrunk its share count by 33.7% since the end of 2015. The stock's up 933% over that same period. I always say own Apple, don't trade it. So tonight, I just want to point out that this is a $4 trillion company that still managed to repurchase more than a third of its shares over the past decade. Third, here's a fun one. Ralph Lauren, one of my favorite apparel stocks in this environment. The company's retired 34.1% of the shares since the end of 2015, though its stock is basically even with the S&P 500 over the same period. That's because Ralph Lauren's true outperformance only started in the past few years, especially this year, with RL up nearly 60%, while many other consumer names are in tatters. Now, the company really came into its fore under CEO Patrice Louvet, whom I think the world of. I am a huge fan. I bet that they draw a lot of attention at the Winter Olympics in a couple of months, where Team USA will be rocking with Ralph Lauren gear. It is still a buy. Fourth is a bank that I've come to like very much over the past couple of years, and that's BNY, the old Bank of New York Mellon. BNY shrunk its share count by 36.2% since the end of 2015, even as its stock wasn't a real outperformer until more recently. Under CEO Robin Vince, we think the world of him, a Goldman Sachs alum who's been leading BNY for the past 3 years or so. The nation's oldest bank has found new life. They focused on selling their entire suite of financial services to investors rather than marketing this stuff as one-off products. And they've also leaned heavily into technology, including AI, maybe the most of all the banks I follow. It's clearly working, as the stock's nearly tripled in a little more than 2 years. Fifth buyback monster, it's another household name. It's Domino's Pizza. Has shrunk its share count by 38.2% since the end of 2015. That's a lot. Domino's is no longer the massive outperformer that it was from 2010 through 2021. The stock's been pretty choppy for the past 5 years or so. But you know what? I think Domino's can win in this current moment because it offers great value at a time when that's what consumers care most about. We had CEO Russell Weiner on the show in October, and after he delivered a strong set of numbers, I thought he sounded very confident in the future. I believe him. I think it's a buy. Now, the next 5 buyback monsters are more elite. They've retired more than 40% of their shares in the last decade. For starters, there's General Motors. Now, get this. General Motors has shrunk its share count by 40.1% since 2015. This one's interesting because GM is simply retiring the new shares it issued during the financial crisis and its aftermath. Still, when you look at the rest of the auto industry, it's clear CEO Mary Barra has been doing a remarkable job. She is so good. After tariff concerns kept a lid on GM for much of the first half of the year, the stock's exploded higher in recent months. It's now up over 50% year to date, trading at its highest level since the company returned to public markets in 2010. The best part, even after this move, GM still sells for just under 7 times next year's estimates. I bet it can keep climbing, especially if we get more rate cuts from the Fed. Now, I expect that. Seventh, one that just reported, Jabil, the contract manufacturer formerly known as Jabil Circuit, which has shrunk its share count by 43.6% since the end of 2015. Jabil's transformed itself from an outsourced, kind of low multiple manufacturer into a company that helps its clients actually design their products and figure out where to make them. Very important now that there are tariffs all over the place. Jabil just reported a fantastic set of numbers this morning. But while the stock initially jumped nearly 10% in response, it eventually gave up most of those gains. But that's because of a full-blown sector sell-off. Holy cow, they were shooting everything today. Now, you're practically getting this quarter for free. I think some investors wanted just to ring the register, given that the stock is up 50%. Eighth, hey, here's one that nobody thinks about that I think they should. It's called Marathon Petroleum, Marathon Pete. It operates the nation's largest oil refining system as well as its largest midstream and retail businesses. Marathon Pete has reduced its share count by an astounding 43.6%, generates a lot of cash since the end of 2015. At a time when I'm still pretty bearish on most of the energy sector, and I'm doubling down soon on that, I like Marathon. The refiners don't need higher energy prices to do well. Sometimes they benefit from lower energy prices, which is one reason the stock's up 25% year to date. Plus, anytime there's a pullback, you can be pretty confident the company's in there buying with you. Ninth, there's HCA Healthcare. I've said I've liked this many times. It operates a network of 190 hospitals, along with roughly 2,400 ambulatory care sites. And that's not even counting their British business. HCA has shrunk its share count by 44% since the end of 2015. I pushed the stock hard in recent years, and it just keeps climbing higher. HCA hit new all-time highs last month, but since then it's pulled back nearly $50 on really no particular reason. I think it is a terrific one to buy. Finally, there's one that I've recommended to you endlessly, and that is AutoZone, the auto parts retailer, which has shrunk its share count by 44.9%. Can you believe that? Since the end of 2015, 44.9%. If you go back to the summer of 1998, AutoZone shrunk its share count by roughly 89%. That's why the stock's been a massive long-term outperformer. I always recommend it. At the same time, I like the fundamentals here. Rates are still high. Getting financing for new cars is expensive, so people need new parts to make their old cars last longer. Plus, AutoZone's pulled back 22% from its highs. You know what? I'd be a buyer. I bet the company is too. Here's the bottom line. When you've got a company with strong fundamentals, a long history of aggressively buying back its own stock, you just might have a winner, especially now that the market's fallen out of love, at least momentarily, with the tech stocks. I want to go to Logan in New Jersey. Logan.
Booyah, Jim.
Booyah, Logan. What's going on?
How's it going? I'm a first-time caller, long-time listener, and a club member.
First-time, long-time club member. Fantastic.
Yeah. I had a question about SoFi stock. Is now a good time to buy, hold, or sell, given its recent pullback?
Okay, SoFi stock is right now enjoying, I could say, a pullback, and I don't want to buy it until I think we're further along in the pullback, because now we've got a very high price earnings multiple. Why don't we wait to see if you can't get the stock at 20? You can buy a little, 23, say, but I don't want you to pay at these prices. Let's go to Leslie in California. Leslie.
Jim, quick question. Sure. What are you going to get the little lady for Christmas this year?
I got her some, she doesn't watch the show. I got her some earrings, and I got her a pocketbook.
All right.
She doesn't watch the show. I'm okay.
Corp, buy, sell, or hold.
Which one?
Dover Corp.
Oh, you know I like Dover. It's a short cycle name. It's recommended by a bunch of people. The stock is finally getting the due that it's worth. I think that Tobin's doing a good job, and I know he can do a lot of things. He's got a great balance sheet. Stock's on a real roll. I want to buy DOV, a club name, and thank you for yeah, I got her. Hey, I did some work. I got her this stuff. All right, to find winners in this market, you want to find companies with strong fundamentals, and I think it really helps to have a history of buying back your own stock. Now, as much more made money from the streaming wars to the wireless carriers, I'm hearing where the consumer's spending their money, time, and attention from research from 100X, and you're not going to believe what I found out. It is going to change your view or make you agree more with the top of the show. Then you can go on Kalshi and place a bet on the Supreme Court that it's going to strike down Trump tariffs, or you can actually invest in companies that would be impacted by the outcome. I'll reveal the stocks that could win if the tariffs are struck down. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. You are in for a treat with this. At any given time, there are major showdowns happening across a host of different industries. And naturally, we want to know who's winning, right? Which brings me to 100X. It's a privately held alternative research firm that surveys thousands of consumers, asking them not how they feel, but what they actually plan to buy. Believe it or not, this is an unusual methodology, and it's proven to be very useful at predicting the future. We know this. I also like that 100X rewards the consumers it surveys by donating to a charity of their choosing. So we're starting to check in regularly with 100X. They've been so good. We brought them back to discuss a trio of battle royals in 3 distinct end markets: generative AI, video streaming, and the wireless industry. So let's take a closer look with Rob Pace. He's the founder and CEO of 100X to learn more. Mr. Pace, welcome back to Mad Money.
Thank you.
All right, Rob, I got to tell you, I am like jumping out of my chair because I have been going over and over again. I've been questioning exactly of the AI sites which people like, and questioning whether ChatGPT is as, let's say, hot as it used to be and therefore worth the $500 billion. I look at your data and I'm not sure that things aren't changing right now.
Yeah, you're right. We have a new champion, and it's Claude, Anthropic.
Jeez.
And for the first time in our data, Jim, they've actually surpassed ChatGPT, OpenAI, in terms of current users saying, am I going to use it more? And likelihood to recommend to a
But they're
friend.
business to business, Rob. How does that work?
Well, it's interesting. If you look at it, there's a number of things they do better. So ChatGPT still has the best experience.
Right.
But really what we're seeing is people care about the results, the references. Can I rely on it? That's true of business, but it's also true about the individual as well. And so that's why we are seeing them ascend in our data.
But I also see that since Gemini 3 came out mid-November, that too is making a big move.
Yeah, they're moving up the ranks. So they would get our most improved award. And you're right, since November 18th when they came out with 3.0, they've really fixed both the experience as well as the quality, and they've closed the gap again with OpenAI. Now, just real quick, two things. They still are all doing well. In other words, current users want to use them, but we do see a kind of a dethroning of where we were 6 months ago.
Look, there's a lot of money being invested right now in the idea that ChatGPT's got this gigantic lead. I don't see that anymore.
Yeah, and you can probably understand then why the alarm bells there.
The red code, the code red, I think if there's something that's hotter than a code red, maybe we ought to look at that. Now, I also want to talk about, I thought this was very interesting, that when I looked at this Google Gemini significant ground versus ChatGPT, you've got this area which shows you that this thing really is very new. So you just got this data.
Yeah, we did. And they've now closed the gap to down where it's really very comparable. And that was not the case even a few months ago. And they're just getting started with 3.0.
Wow. Okay.
So you see that compression.
It is incredible. Now, let's talk about the next battleground. I have been questioning why Netflix felt that they needed to have Warner Brothers until I saw a chart that you have about what YouTube is doing. Again, a Google product.
Yeah. So again, this is a little out of the box, but you're right. In terms of Netflix, they are number one or number two in everything we track.
Right.
So it does beg the question, why? Now, if you think more broadly, though, where we see real strength is in YouTube. And we see it with the younger consumer. We see it with the more diverse consumer in terms of their future time they're going to spend. And I think the key thing, Jim, is to think about in investing, I think you need to think about share of time or share
Well, that's what Netflix tells us to do.
Share of stomach, et cetera. So don't sleep on YouTube, even though it's viewed as short form versus long form. That may be the future battleground.
Well, what's clear to me, I had been saying to David Faber, I don't know why the heck Netflix has to do it. I have completely flipped based on your data. I think they have to do it.
Yeah, it does. It might argue that it's more defensive than offensive.
I didn't see Paramount doing all that well in these.
Yeah, I mean, you can understand the industrial logic or the business reason for why they would want to combine, right? Scale, et cetera.
Right.
So the desire makes sense, but they're not as competitive for sure in our data.
No, not at all. That was really eye-opening. And then the final one, we know that there's billions of dollars up for grab when it comes to telco. And I had always felt that Verizon was doing incredibly well and offered a pretty good deal. I am changing my view based on what you've come up with here.
Yeah, T-Mobile, if you synthesize everything. So to be fair to Verizon, they do have the best network coverage area overall.
Right.
But T-Mobile has closed that gap such that they're good enough, and they do far better on price, value, plan options. Even the in-store experience now is superior.
Now, that is very new. People always said the Verizon stores are fantastic. So what this told me, Rob, is that the consumers not doing that well or feeling low, then they're going to switch, maybe. Is there a lot of switching going on, you think?
Yeah, it's value. I mean, you've been on this, but there's one theme we're seeing in our data is value.
Now, in terms of all the things that we see, I just want to go back to the ChatGPT for a second. I thought these things would be glacial, that it would take a long time to unseat someone. It turns out to be, whether we also look at that, the wireless, but it turns out it can happen like lightning, which says to me, Rob, that look, you worked at Goldman, those franchises, you got to be careful about the valuation. When you're going to do more than $500 billion for ChatGPT, I think that means you better believe that they're pulling away, not that they're dropping.
Yeah, you're not seeing fortress in our data, for sure.
Well, I don't know. If I were one of these companies that's putting money in this thing at a $500 billion valuation, I would think again. I don't think you'd disagree with me.
You know, what we are seeing, though, is across all these platforms, they really are helping with productivity.
Right.
So there's there.
Okay.
It's just who's going to win is more important.
Well, in a scrum, I don't want to pay that much more for one than another if it's a scrum. I like one that's up here and the rest are there. I don't see that anymore from your data.
Correct.
And I know your data would have showed me that at one time. Rob Pace, these changed my mind about things, Rob. They literally changed my mind, and they changed your mind, too. That's Rob Pace, founder and CEO of 100X. That money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Chris Cramer, that's our Ralph Rolls. I'm just saying when it starts to buy, sell, so there's been a course ahead of time. My staff person, the graphics, will play you plan this out. And then the lightning round is over. Are you ready, Ski Daddy? Tell me the lightning round. Let's start with Felix in Arizona. Felix.
Hey, Jim. Thanks for taking my call. I just want to get your thoughts on Pfizer.
Okay, Pfizer, really good yield. Not a lot of momentum. Didn't like the update yesterday. I'm going to say just weak hold. Let's go to Jim in Texas. Jim.
Hey, Jim. This is Jim in Texas. So I'm an investment club member from the start and a second-time caller.
All right.
My question is about a stock that's not retail, but more of a supplier to retail.
Okay.
And they deal with both livestock and pets.
Okay.
So they're a pharmaceutical business called Elanco.
They are doing everything right. I am so impressed with the way they've turned that company around. I'm glad you brought it out. That was a real good idea. Let's go to Tina in Florida. Tina.
Hey, Jim. Thanks to you and your team, and happy holidays.
Oh, same to you. Thank you.
Thank you. Thank you. Thanks for everything you do for us home gamers. I was wondering if would Rocket Lab be a stock that you would include in the end of the year of magical investing?
I think Rocket Lab is better than that. I don't think it's a magical thinking stock. I think it's a very good spec ahead of another big offering in the rocket world next year. I think you can own it as your spec play, as I say in How to Make Money in Any Market. Let's go to Brandon in Arizona. Brandon.
Booyah, Jim.
Booyah.
Merry Christmas and Happy New Year.
Oh, same to you. Thank you.
What you think about LAC, Lithium America?
No, there's nothing there for you. You're just going to have to skip it. That's a yesteryear stock. It's just it's a no-go. Greg in Minnesota. Greg.
Yeah, hi, Jim.
Greg.
How are you, bud?
All right, how you doing?
Yeah, good. The sixth-time caller. Thank you very much. I need to buy, sell, hold on this scoreboard company that has a new CEO, a new CFO, and a new 30-handle price target. It's institutionally held by BlackRock and others, Daktronics.
Okay. You know, it's just okay. I've never been excited about that scoreboard business. Advertising, it's just not compelling enough to put your money into. Let's go to Jerry in Arizona. Jerry.
Mr. Cramer, good afternoon. The stock that I'm asking about has a over 11% short position on it. Analysts only have strong buys, and no sales. So is my stock, Theravance Bio, a buy, sell, or hold?
I got to do work. I've not looked at Theravance in a couple of years. You deserve better than that. I will come back. Let's go to Tim in Pennsylvania. Tim.
Hi, Jim. Hey, fellow Eagles fan and club member here.
All right, thank you.
Yep. Hey, I know you're not a big fan of beer and liquor companies due to Lilly's GLP-1 drug.
Yes.
But this stock is more of a new CEO turnaround story that I know you like Wells Fargo, Nike, Starbucks. So they call the new CEO at Diageo Drastic Dave Lewis, who has successfully turned
but let
around.
me give you I think that the dividend at 5.6 can keep it here. They have to come up with something very special because I see a lot of their lines of business not doing well. Okay, I'm going to throw in Constellation and Brown-Forman downgraded again, too. I don't own stocks just for dividend, but I think it can stop right there because of the dividend. Let's go to Bill in New Mexico. Bill.
Hey, Jimmy, it's Billy in Santa Fe.
I had a feeling. What's happening?
My stock is Photronics.
Something's happening with that stock. The thing is just like skyrocketed. I have to figure out what that, Jesus, 2 different calls in one lightning round. But look, if I don't know it, I'm going to just say I don't know it. I can't make it up. Let's go to Miles in Florida. Miles.
Jim, how are you? And shout out, thank you for your book, and Merry Christmas to you and your team. They are fantastic.
Thank you. The team is fabulous, and thank you for the kind words about my book. How can I help? Good
MTB, short-term,
very well-run
long-term
bank. It's still not that expensive. Actually, it's surprisingly inexpensive. I would buy that stock tomorrow morning, even though it looks like it's up to spike. It's at 12 times earnings. There's nothing not to like about M&T Bank. It's good. Let's go to Chris in Colorado. Chris.
Howdy, Jim.
What's going on?
Long-time listener, member of the club, and
thank you.
I asked Santa for the book.
Oh man, I hope Santa doesn't let you down. Let him. I wish he'd take down another 300,000 when he's in there. What's going on?
Well, Jim, this company was originally a graduate of the year of magical investing, but now all of a sudden revenues are up 600% this year. They're sitting on $800 million cash in the bank, and this $3 billion market cap expects to be cash flow positive next year. Jim, the stock's owned us.
I mean, that thing is just look, I view that as a cats and dogs thing, to be honest. I cannot go. Wow, that one is a really complicated stock, and I don't know why I think that necessarily it's going to start taking off from here. I'm going to have to take a pass. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Owning stocks, picking stocks, figuring out the odds of something good happening, all of that is integral to the process of making money. Right now, the Supreme Court's deliberating the issue of the president's tariffs. And if they strike down the tariffs for being unconstitutional, that would be a huge win for multiple retailers who import so much from China. But will the Supremes really rule that way? That's the dilemma for investors and gamblers alike. If you go on our partner, Kalshi, you will see that the crowd's betting heavily against the tariff surviving. If you wager $100 that tariffs stay intact, payoff is over $350. Wowza! But there's another way to look at this. It's called investing. Right now, we have a host of stocks that have been punished mightily by tariffs. Let's talk about the ones that have been hit hard. First, there are the dollar stores. We all accept the cliche of the cash-strapped consumer, right? A strapped consumer often goes to dollar stores. There's a perception that these stores have a ton of Chinese exposure, so their sales and earnings have been hurt by the tariffs. Both Dollar General and Dollar Tree are extremely well-run companies. They've spent a great deal of their conference calls talking about how they've mitigated much of the Chinese exposure, but they can't get rid of it all. There's still too much of it. And the tariffs don't just apply to China either. As Dollar General CEO Todd Vassos pointed out in his June conference call, quote, we have successfully reduced our China exposure to less than 70% of our direct imports, and we estimate less than 40% of our indirect imports are sourced from China, end quote. Still, Vassos says he's had to raise prices as a last resort. Dollar Tree mentions the tariffs as a cause of volatility, which to me means variable pricing. The company, like Dollar General, is doing its best to keep prices low, but the tariffs are still a factor. Five below. A company has been on fire, even though its merchandise has been heavily tariffed, would benefit enormously if the tariffs get struck down. How about two I really like right here? Williams-Sonoma and Gap. Their tariff hit is pretty variable and pretty covered. These are all moving targets, but these two companies are firing on all cylinders. Williams-Sonoma is even guiding for a modest year-over-year increase in operating margins at the midpoint, despite the tariffs. Stock buyers will not check to see how much these companies might save with the tariffs going. They'll just buy. And Costco has joined a list of companies suing the Trump administration for a refund. I don't know how much that would be and who would get it, but a victory against tariffs may break the company's stock from its continued and endless and terrible tailspin. So the question is, should you go Kalshi or should you invest in these sure winners if you think the Supreme Court will strike the tariffs down? You know what? I say go with the retailers. I think that every one of these stocks would go up if the Supremes strike down the tariffs. And if the president prevails, I bet that these retail stocks won't get hammered all that badly. To me, the better risk reward is with the stocks, not the prediction markets, because the prediction markets are pure gambling. And gambling is all or nothing. The truth is, I have no idea which way the Supreme Court will rule here, so it's better to invest in stocks that won't get hit particularly hard, even if this case goes against them. I like to say, there's always a bull market somewhere. I promise I'll find it just for you right here on Medline. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.